Chapter 2. Interest Rates. Section 3. Yield and Borrowing Costs. Yield and borrowing cost are really two ways of describing the same debt deal. From the investor's side, it's the return earned. From the borrower's side, it's the interest cost paid, both shaped by the same market price of credit. For bonds, yield can be quoted in a few different ways, but yield to maturity gives the most complete picture. It connects today's price to all the cash flows ahead, including coupon payments and any gain or loss when the bond matures. A borrower's true cost is not just the coupon written into the bond contract. What really matters is how much cash the issuer actually receives up front, because raising less than face value pushes the effective cost above the coupon, while raising more pulls it below. The market ties these two perspectives together through price. Investors demand a certain yield for a given level of risk and maturity, and bond prices adjust until that required return lines up with the issuer's effective cost of funds. You can often tell a lot about yield just by looking at price. If a 5-year bond with a 4% coupon trades at $9.50 instead of $1,000, investors are getting the same coupon plus a price gain by maturity, so the yield ends up higher than 4%, at about 3%. That same $9.50 price matters just as much to the issuer. If the company only raises $9.50 today, but still has to pay $40 a year and return $1,000 at maturity, its effective borrowing cost is closer to 30%, not the 4% coupon. Changing market rates don't affect every kind of debt in the same way. Existing fixed-rate bonds keep paying the same coupons. Their market prices move as yields change. New borrowing reflects current rates, and floating rate debt can reset fairly quickly. Suppose GreenTech issued a 10-year bond at 5% when market conditions allowed it to sell at par. If similar bonds later yield 6%, the old bond's price falls to around $926 for investors, but GreenTech still owes the same fixed $50 a year and $1,000 at maturity. Only new borrowing becomes more expensive. There's also a handy shortcut for estimating yield to maturity without a calculator. If you add the annual coupon to the annualized gain and divide by the average price, both of these below par 3% bonds come out near 4%, showing that borrowing costs today can sit above the stated coupon. The biggest mistakes usually come from mixing up contract terms with market economics. Keep these anchors in mind. Coupon rate is not the same as borrowing cost, bond prices, and yields move in opposite directions. Different borrowers face different costs, and fixed-rate debt does not react the same way as floating-rate debt.